A bank will lend you $300,000 to buy a house. That same bank will not lend you $900 to buy a phone. The difference is not the price. It is how fast the thing stops being worth something. This past Monday, Nvidia and 6 of the largest money managers on Earth signed papers designed to move artificial intelligence chips out of the phone category and into the house category. In the next few minutes, 3 things: what was signed on Monday and what was not. The 4 questions a lender asks before it will lend against anything, because chips pass 3 of them easily, and this whole story is stuck on the 4th, and then where that loan actually ends up. I am not going to tell you whether this is a good idea. I do not know, and nobody does yet. What I can do is show you how it is wired, so you can tell which part of a headline this size is a fact, and which part is an estimate. Let us start with what actually happened. On August 10, 2026, Nvidia announced it had signed memorandums of understanding with 6 firms: Apollo, BlackRock, Blackstone, Brookfield, Goldman Sachs, and KKR. The stated goal is to establish compute financing platforms to mobilize over $500 billion of third-party capital. 3 things in that sentence deserve slowing down. First, a memorandum of understanding is an agreement to agree. It is not $500 billion sitting in an account. It is 6 of the biggest capital allocators in the world saying, in writing, that they intend to build the plumbing. Second, the phrase is third-party capital. Nvidia is not putting up this money. The platforms are independent, and the firms and their investors carry the underwriting and the risk. Hold on to that one. The difference between lending your own money and arranging for somebody else to lend theirs is the entire difference between this story and a story I will tell you later. And third, the part that matters most. Here's what Jensen Huang said about why his chips belong in this category at all. Quote, "Nvidia compute is uniquely suited for this role. It is broadly adopted, flexible across models and workloads, fungible and transferable across customers and operators, and continuously improved through CUDA software, extending its useful life and improving its economics over time." Read that last part again. Extending its useful life. That is not marketing language. That is the load-bearing wall of this entire $500 billion structure. But first, why now? Why does the most profitable chip company in history need Wall Street to arrange financing for its own customers? Because the build-out has outgrown the cash. According to a FactSet analysis published in late July, the big cloud companies are on track to spend more than $690 billion on capital projects this year, over 80% growth in a single year. Different research houses count different companies and land on different totals, so you will see figures either side of that one. The direction is not in dispute. Here is the number that actually tells the story. The share of that spending funded by new borrowing went from 9% of capital expenditure in the 2024 fiscal year to 32% by the middle of this year. 9 to 32 in under 2 years. So the build-out is being paid for less out of profit and more out of debt. And borrowing at that scale runs into a very old set of rules about what a lender will accept as security. Which brings us to the 4 questions. When somebody lends money against a thing, they are asking 4 questions about it, whether they say them out loud or not. 1. Do a lot of people use it? A thing nobody wants is not security. It is inventory. 2. Can it be moved to somebody else? A custom machine bolted to one factory floor is worth almost nothing to a lender. A shipping container is worth a great deal. 3. If I have to sell it, is there actually a buyer standing there? Not in theory. On the day. And 4. Will it still be earning while the loan is still owed? Now, go back to Huang's sins and something jumps out, broadly adopted. That is question 1. Fungible and transferable across customers and operators. That is questions 2 and 3. He is answering the checklist in order, in public. And on those 3, the answer is genuinely yes. This is not a thought experiment. It has already been done. In August of 2023, a cloud company called CoreWeave borrowed $2.3 billion in a facility led by Magnetar Capital and Blackstone. The security for that loan was Nvidia H100 chips, not the company, not its contracts, the physical processors. It is one of the earliest and most quoted examples of somebody treating a graphics processor the way a bank treats a building. And CoreWeave's chief executive, Michael Intrater, described the negotiation in a way I have not been able to stop thinking about. He said they negotiated how much collateral would go into it and, quote, what the depreciation schedule was going to be versus the payoff schedule. That is the entire subject of this video, in one sentence, spoken by the person doing the borrowing. 2 schedules, 2 clocks. 1 clock is the loan. It runs on contract time, fixed payments, fixed dates, printed on paper years in advance, and it does not care what is happening in the world. The other clock is the machine. It runs on physics and on demand, and nobody has ever printed that one in advance. Where the 2 clocks disagree, there is a gap, and somebody eats it. So how long does a machine like this actually keep earning? Here is the uncomfortable answer. Nobody knows, so companies estimate it. That estimate has a name in accounting: useful life. It is the number of years a company says equipment will keep being productive, and it sets how fast the cost is charged against profits. Longer estimate, smaller annual charge, bigger reported profit. Same machine, same electricity, different number at the bottom of the page. And these estimates have been moving. In January of 2023, Alphabet extended the estimated useful life of its servers from 4 years to 6, and certain network equipment from 5 years to 6. The disclosed effect: $3.9 billion less depreciation and $3 billion more net income. Microsoft had made the same 4 to 6 year change 6 months earlier. Meta moved certain servers to 5.5 years from the start of 2025. Now, here is the part that makes this genuinely interesting rather than merely cynical. In February of 2025, Amazon went the other way. It shortened the useful life of a subset of its servers and networking equipment, from 6 years back down to 5. And the reason it gave, in its own annual filing, was an increased pace of technology development, particularly in the area of artificial intelligence and machine learning. That decision cost Amazon about $700 million of operating income in 2025. Same industry, same chips, same physics, opposite conclusions, and one of those companies chose the version that hurt its own reported earnings. The investor Michael Burry made this a public fight in November of 2025. His estimate was that the large cloud companies will understate depreciation by roughly $176 billion across 2026 through 2028. By 2028, he projected Oracle's earnings would be overstated by close to 27%, and Meta's by around 21%. His argument is that the real replacement cycle for this hardware is nearer to 2 or 3 years than 6. That is his estimate and his accusation. It is not a finding of fact, and I am going to be careful about the difference, because there is a serious answer on the other side, and it is not a dodge. A chip does not die at 3 years. It gets demoted. The newest silicon goes to the hardest job, training frontier models, and it moves down to serving those models to users, then to smaller models, cheaper jobs, less demanding customers. It stops being the best machine long before it stops being a useful one. If a business genuinely has that ladder, and the largest cloud companies do, then 6 years can be an honest number. So who is right? I cannot tell you, and I want to be precise about why I cannot. The answer depends on how much demand exists for 4-year-old chips in the year 2030. That demand does not exist yet. Nobody can check it. Not the people making the estimate and not the people attacking it. What I can tell you is this: it is an estimate, and that estimate is now sitting directly underneath a loan, which is a position somebody has been in before. In the fiscal year ending September 1999, Lucent Technologies was the largest telecommunications equipment company in the world. $38.3 billion in revenue, $4.8 billion in profit, 153,000 employees. Lucent sold networking gear to telephone companies. In the late 90s, many of its keenest new customers were startups that wanted to build networks but could not pay for the equipment. So Lucent lent it to them. One of those customers was a fixed wireless company called WinStar. Lucent had agreements to provide WinStar with up to $2 billion in vendor financing, money from Lucent, so that WinStar could buy from Lucent. In 2001, Lucent declined to extend a further $90 million. WinStar was forced into bankruptcy. Lucent wrote off $700 million in bad debt from that single customer. And WinStar was not the only one. At the end of the 2000 fiscal year, Lucent had agreements to provide customers with up to $8.1 billion in credit or loan guarantees, with almost $2.1 billion already drawn. By fiscal 2006, The revenue of what had been the largest telecom equipment maker in the world had fallen from $38.3 billion to $8.8 billion. Now, I want to be careful here because this comparison is being thrown around a great deal at the moment, and the slobby version of it is wrong. Lucent was lending its own balance sheet. That is what vendor financing means. The seller finances the buyer, so the seller's revenue and the seller's credit risk end up being the same transaction, wearing two hats. What was signed on Monday is explicitly not that. It is third-party capital on independent platforms, underwritten by other people's investors. And Nvidia has pushed back on the comparison directly. It sent a 7-page memo to financial analysts denying that it uses vendor financing at all. That difference is real, and I'm not going to pretend it away to make a neater story. But here is what does carry across those 27 years, and it is not a company, it is a question. When the buyer cannot pay, who is holding the paper? In 1999, that was easy to answer. It was Lucent. It sat on Lucent's own balance sheet, and when it went bad in one place, in public, with a name on it. Today it is a harder question, so let us go and find the answer. In October of 2025, Meta announced a joint venture to build a data center campus in Louisiana called Hyperion. Funds managed by Blue Owl Capital owned 80% of that venture. Meta kept 20%. Total development costs, approximately $27 billion. And here is how it was funded. In Meta's own words, a portion of the capital raised by Blue Owl was funded by debt issued to PIMCO and select other bond investors through a private securities offering. So follow that. A data center gets built. Most of it is owned by an investment vehicle rather than by Meta. That vehicle borrows. And the lenders are bond managers, the kind of firms that run the bond funds sitting inside ordinary retirement accounts. Did the risk leave? Partly. And Meta disclosed the part that did not. It gave the joint venture a residual value guarantee for the first 16 years of operations, a capped cash payment based on the value of the campus, if certain conditions are met after a lease ends or is not renewed. That is a structure, not a scandal. I point at it because when people say debt is moved off the balance sheet, this is the fine print describing what stayed. Keep following the paper downstream, and it goes where credit always goes, into bond funds, and into the insurance accounts standing behind annuities, which are the products people buy precisely because they want something predictable. How much of that is private credit is genuinely disputed. Life and annuity insurers hold something like $6 trillion of invested assets, and researchers put private credit at around $1 trillion of it, with other estimates much higher. There's no agreed figure, and that absence is itself worth knowing. And there's one more pipe being widened right now. In August of 2025, an executive order directed the Labor Department to look at letting workplace retirement plans hold alternative assets, private credit among them. In March of this year, it proposed a rule, creating a safe harbor for the people who choose what goes on a plan's menu. As of today, that is still a proposal, not a final rule. I checked before recording, and I am saying so out loud because this is exactly where an explanation usually turns into a scare. I'm not telling you there is data center debt in your retirement account. I cannot verify that, so I will not say it. What I can verify is that the proposal routes most ordinary exposure through target date funds, which are the default option in most plans, the place money goes when nobody picks anything else. The pipe is being widened. That is the fact. What flows through it has not been written yet. So let us go back to the house and the phone. A bank will lend against a house because a house is still standing in year 25. It will not lend against a phone because by year 4 the phone is a drawer ornament. Every lending decision ever made is a bet on how long the thing keeps being worth something. $500 billion of intended capital now rests on one version of that bet, that a chip bought this year is still earning in year 6. So here are 3 questions worth keeping, and they work on almost anything: a data center, a car loan, a mortgage, a country. What is the collateral? How long does the loan run compared with how long the collateral earns? And who is holding the paper if it goes wrong? None of this is hidden, by the way. Nvidia published its own press release. Meta filed its own joint venture. Amazon printed its reasoning in an annual report anybody can download. It is not a secret. It is just written in a language that was never really meant for us. And underneath all 500 billion of it, there is one number that nobody actually knows. Educational only, not financial advice.